Hi, welcome to Numerix Video Blog. I'm your host, Jim Jockle. 60 days is the magic number, and no, not the Rio Olympics, but the pending Brexit. And joining me today to discuss the developments as they occur is Vice President of Business Development here at Numerix for EMEA, Udi Sella. Udi, how are you, sir?
Excellent. Great to be here again, Jim. Thank you.
Thank you, Udi. Now, the sterling is hit at an 18-month low against the euro in advance of a potential Brexit. First question to you are, how are corporates as well as other institutions thinking about hedging against this potential risk in the market?
Jim, that's a very good question because we have seen that the price volatility on sterling has indeed risen a few notches since basically the announcement of David Cameron about the referendum. And this could imply two things. You know, one thing is that investors are actually putting on positions on the book or even hedging. And then, of course, British business people need to hedge the currency risk, which most likely would be leading to weakening of the pound.
So a lot of controversy around London from a political standpoint this week as well. I mean, obviously David Cameron doesn't want to see the Brexit, but yet, the London political scene with the election of a new mayor is, creating some questionable unrest as it relates to the global economy and how things will play out. From an FX perspective, what should investors be thinking about as it relates to some of this volatility, and are there any strategies that would be typical in this type of evolving environment?
Yeah, so a couple of interesting things to say about that. So as we said earlier, probably the risk to hedge is weakening of the sterling, right? So that means that as an exporter, right? So you receive dollars and then you need to convert them to pounds. So basically, for exporters, it's probably a good thing, right? But if when you're importing into Britain, then the purchasing power for you to purchase, let's say, commodities like oil. Obviously, we know the UK is not rich in natural resources. That's going to be an issue. And even more interestingly, as you know, and we've discussed it a few times during our blog, the biggest challenge these days of central bankers is inflation.
Let's turn to oil for just a second. Obviously, a little bit of a rebound, and also recent concerns about all the fires in Canada now that have been threatening some of the production numbers. What's the near-term outlook?
Yeah, so it seems that most of the producers, also like the bigger ones, so Saudi and Russia and the OPEC cartel, and to a certain extent Iran, because we're not sure what is going to happen with the Iranian quota, is that they managed to agree some kind of a base price, and we see support for oil thanks to that. And of course, you mentioned Canada, so I think it's a few million barrels a day, which are now off the market. And there is also a slowdown in China. You may have seen that both imports and exports have declined. Therefore, the need for oil is not as it was, and that reduces the demand a bit. So it's not just about the offer, but also the demand, which is weakening a bit, and also with the economy.
So as we're rolling to the end of 2Q, now here in the beginning of May, what are some of the key indicators you're thinking about amid this unrest right now?
So clearly, we mentioned the price of an oil barrel. So this is something we're definitely looking at. I keep looking at the yields. I see that, for instance, the 10-year U.S. note is around 184. So it doesn't really manage to break the 2. So if you like, the curve is still pretty flat. And if you look at we spoke of the Brexit. So I'm looking at the gilt, right? As opposed to the dollar, the spread is like 40 basis points. So if you like, the yield of the gilt is around 140, which is extremely low. And we mentioned commodities, etc. So if you look at currencies like and economies such as Australia and the Australian dollar, they just cut rates recently last week, and basically no inflation there, and the rates are historically low. So it seems that we're still stuck in this cycle of very low inflation. So that's really what I look at, because I think the indicator for coming out of the woods would be rising inflation.
Well, Well, Udi, I want to thank you so much. And of course, for all the fans of the Numerix video blog, why don't you shoot me an email? For the first 5 emails I'll get, I'll make sure you get a nice little sporty Numerix hat. Udi, thank you so much for joining us again. We want to talk about the topics that you want to talk about. Follow us on LinkedIn or on Twitter at NX Analytics. Udi, we'll talk to you next time. Thank you.